Markets are under pressure this morning once again. Futures indicating a decline at the start of trading this morning to the tune of 65 points on the Dow Industrials on the heels of another volatile week on Wall Street last week. The Nasdaq this morning down 20 points. Global stocks extending Friday's declines as well amid escalating fears over the fate of the U.S.-China trade. Investors bracing for backlash in Britain over the U.K.'s looming parliament vote to exit the European Union. And by the way, last week, one of the worst weeks for the markets, down better than 4% last week alone. Joining us right now is the CEO of ETF Trends, Tom Lydon. And Tom, it's good to see you this morning.
Hi, Maria.
The trend this week and this month has been to sell. Any place to hide in terms of what you're seeing?
No, investors are wringing their hands this weekend for sure. We're at a critical tipping point. The bellwether of world markets is the S&P 500. And as we get down and touch 2620, where this may be putting in a triple bottom, that would be great. If it goes through 2620, I think a lot of people are concerned we're going to see lower lows. Around the world, as you folks just mentioned, we've got a lot of concern. However, there's something that's peeking its head out, which is emerging markets. We're starting to see a lot of money move into emerging market ETFs, which I think are investors looking for value. We've got P's in single digits. Emerging markets have been really beat up for a long period of time, and we look at flows that are going into ETFs or out of ETFs that really tell us where smart money might be going.
Is money, Tom, that's coming out of equities right now, which is driving down all these indices, is it just sitting in cash on the sidelines? You mentioned emerging markets, but for the most part, are they just sitting in cash waiting for the bottom to jump back in?
We've seen a lot of flows into short duration bonds, both active and passive ETFs in that area. But actually, large cap growth has been, again, the bellwether, where we haven't seen money coming out. We've seen a lot of money going out of quality, value, those types of factors for sure, especially ETFs around the world continue to sell off as markets continue to get weaker. I think the key thing here, as we go into the end of the year, managers are on a precipice. Am I going to show big cash values or allocations at the end of the year because my clients are concerned about what might be coming on next year? I don't want to look like I'm fully invested if the market's declining. On the other hand, if we happen to see a rebound off of this 2620 level, you don't want to be looking like you've got a bunch in cash and not participating.
Wall Street Journal front page this morning that one trend that is worrisome is broken, the buy on the dip. That this is the first time since the dot-com bubble burst that the S&P typically rebounds after posting a weekly loss, like after what we saw last week. The buy-the-dip trend has broken apart. And typically, this is the kind of behavior Morgan Stanley says that in only years in which stocks haven't reliably following dips has been either the start or in the middle of a bear market. Yeah. So people are not willing to step in. And I'll point out another worrisome sign last week were the transports. The transports fell 8% last week. That was the worst performance in more than 7 years. And so if you think that's an economic indicator, it was not a good one for the economy and the market last week.
Looking at the 200-day average, bad, and also we had this technical death cross where the 50-day average went down below the 200-day. Again, Dagan, as you point out, not good for investors. It's going to be interesting to see what happens in the next couple of days.
There are also fundamental issues in terms of profit margins getting squeezed as a result of input costs going up and tariffs. There's this trade uncertainty. U.S. Trade Representative Robert Lighthizer confirmed a hard deadline of March 1st for a trade deal with China. That threatens a fresh round of tariffs if the two countries cannot reach an agreement. On Sunday Morning Futures yesterday, White House National Trade Council Director Peter Navarro joined me, weighing in on what's next in these negotiations.
We know that China has unfortunately never honored a single major commitment it's made going back to the World Trade Organization entry, and in 2015 promising to stop the cyber intrusions into our businesses. Right. They just keep doing that stuff. But this is different. This president, Donald J. Trump, they respect him, they fear him, and if anybody can get a deal, it's going to be President Donald J. Trump with Ambassador Robert Lighthizer.
All right. Now, the other thing that he said on Sunday was that there was an acknowledgement in Argentina by the president of China that we will address intellectual property. I thought that was a good, important indicator because up until now, Jason, they haven't even admitted it, that they have been stealing our IP for decades.
No, it's just so bad. It's been going on for decades, and I think Donald Trump has actually taken the right stance. But it's the beginning. You can't just flip the switch and suddenly turn that on.
Especially with a bureaucracy like China.
It is so big and so prevalent, and there are other issues out there as well. But it is an acknowledgement, and the first step is being made.
But is that a big issue for markets, you think?
It absolutely is. I think what you see is investors, the IP aspect, especially in technology, is key and critical. I mean, we've talked about trade, we've talked about taxes and how that affects things, but intellectual property in China amounts to, they're saying, hundreds of billions of dollars, what that could mean. The question is, are they going to put the hammer down?
Yeah.
And up until this point, we haven't had a lot of confidence.
What were you saying,
No, I was just going to say that I think what happened on Friday, Peter Navarro was blamed for the market sell-off, quite frankly, because of some comments that he made about this 90-day negotiating period. The White House might be doing the right thing, but you have to be careful about the messaging and maybe not put some people on during market hours. I think that you really have to start thinking about that. Somebody joked to me over the weekend, who I know voted for President Trump, said, yeah, we're talking about the Navarro short strategy, trying to get his media appearance schedule if he's on during market hours. I joke, but I think that it is a messaging issue. Even if this is the right strategy, you have to be careful about how you communicate about it and with one voice, maybe one person, not multiple people on talking about it.